being a first-time home buyer, what does that mean to you when it comes down to getting a loan? Now, there's several different things that you need to take into consideration, and I think the biggest factor is the amount of money that you have available to you as a down payment for being a first-time home buyer, and I will explain as to why I bring that up, and also the amount of income that you make as a first-time home buyer, which will determine the type of loan that would be best suited for you. So let's start from the top, okay? Let's assume that you have a minimal down payment, which seems to be the theme with a first-time home buyer, is that a lot of individuals that are entering the housing market seems to be people that are actually able to afford the property. However, they have a challenge when it comes down to the amount of down payment they're able to put. These are people that typically haven't had the opportunity to work for such a long time. So maybe somebody that graduated, you know, a lot of new families, not everyone for sure, but that seems to be the theme. And so what I find in commonality is that these people tend to have the ability to finance or even overfinance the amount of home that they're looking for, but they have a difficulty when it comes down to putting more than 3, 5, or 10% down. And so if that's you, let me tell you what's available. Now, we're gonna touch on a couple different things, and the reason is there are agencies out there called Freddie Mac and Fannie Mae, and they actually buy the mortgages from the lenders nationally, no matter which lender you use to originate your loan. And there's a checkbox of items that they require, and the reason I bring that up is because those agencies are government backed, and it's nothing like FHA. It's just the typical agency that buys agency loans or conforming loans, the typical loan that you get when you walk into a bank. And they have options for you to finance the property with as little as 3% down payment. So let's talk about the pros and let's talk about the cons. The pros is that you're able to finance a property with as little as 3% down. Therefore, you might have just enough saved to be able to finance the property. The con is that the less of a down payment you have, the higher your payment is, the higher the mortgage is. In addition to it, there's something called mortgage insurance. So anytime you have less than 20% down on a property, you actually have to pay mortgage insurance. And mortgage insurance is not equal across the board, meaning that if I have, as an example, 3% down or 5%, 10, 15% down, I don't actually pay the same amount of mortgage insurance. It's just like insuring anything else. The more of it you insure, the higher it costs. Typically speaking, mortgage insurance runs about 0.5% annually. However, these programs that I was talking about through Fannie Mae and Freddie Mac, Fannie Mae is called Home Ready, Freddie Mac is called Home Possible. They offer reduced rates of mortgage insurance. However, what I do find nowadays, and it's pretty surprising, is that the conventional market is pretty much in line with the cost of mortgage insurance across the board. So typically it used to be about 0.5%. Now it seems to be closer to 1/4, which was the real benefit of using some of these first-time programs, homebuyer programs. From Fannie Mae, it's called Home Ready, and from Freddie Mac, it's called Home Possible. Again, the idea was that you, as the first-time homebuyer, are financing these properties and getting a reduced amount of mortgage insurance premium, which is the amount of insurance that you have to pay when you have less than 20% down in the property. Now, there's restrictions to these programs, because if you go online and you type in Home Ready or Home Possible, you actually put in the address of wherever it is you're looking, typically the zip code or the city, and you'll see the income restrictions. Around this area, I believe it tends to be, and I'm in LA, it tends to be somewhere around $50,000 to $60,000. So if you're making more than that, that's the median income, you will not qualify into that program. However, I don't think it's a big deal whether you do or not. I think something to keep in mind is that as an owner-occupied property, you can get gift funds. And so if you are short on funds to close and you have a family member who's willing to gift you the down payment, then it's all the same, okay? And in terms of rates, the rates would be extremely comparable, if not the same. So there's not a huge benefit through the agency programs to not do a conventional mortgage versus a home ready or a home path. I'm gonna throw in there that there is a program that most everyone has heard of that is called FHA through Federal Housing Administration, right? And you put 3.5% down. I do not like originating an FHA loan unless I absolutely have to. And the reason is FHA has 1.75% upfront mortgage insurance. A lot of people don't know this. So the second you close escrow, you actually pay 1.75% into a pool that allows the government to insure these high leverage mortgages, meaning that, you know, people come in with 3.5%. You do not have to do that with Fannie Mae and Freddie Mac. However, the flexibility comes when you've had some credit derogatories, meaning you've had issues with your credit in the past, like, you know, late payments or bad credit, you know, delinquencies, judgment, different things like that, that offer more flexibility for using the FHA product, specifically credit related. So that could be a solution. That could be a solution. Also, if you were somebody who was enrolled in the Army and you wanted to apply for a VA loan, you could potentially come in with as little as 0 down payment, you know, to secure that mortgage. So those are all things that are available to you. I feel like the biggest thing that you should do as a first-time home buyer is talk to a knowledgeable loan officer who can run your numbers and let you know approximately how much money you can qualify for a home. And I can go in pretty deep on that, on qualifying, but I'm not going to do that in this video. I just want to touch on being a first-time home buyer. I think the big thing to keep in mind is that if you didn't want to pay the upfront mortgage insurance and you still wanted to go with the low down payments, I would look at Fannie Mae and Freddie Mac loan options. And I would understand that the lower my down payment is, the higher my mortgage insurance is going to be. You can refinance out of that, or that kicks out once you have 20% of equity in the property, okay? Or if you put down 20%, then you have no mortgage insurance. Something else to keep in mind, which is pretty important, is if you're shopping for a condo versus a home, you gotta let whomever it is that's sizing up your loan know that it's actually going to be a condo, because most condos have a $300 to $500 homeowner association, and you got to factor that in when you're factoring in your income. This will determine how much money you're able to afford, because remember, another $200, $300, or $500 a month is another monthly expense. That's it, guys. I mean, we can go deeper, but I think this kind of gives you a broad framework of what it looks like to be a first-time home buyer. Please, if you have any questions, put them in the comments. However, if you did enjoy the video, I would really appreciate if you give it a thumbs up and subscribe to the channel. Otherwise, again, thank you for watching, and I'll catch you on the next video.